central bankers are faced with a dilemma in regards to interest rates and inflation. With no prior experience to fall back on, they are grappling with determining which factors affecting inflation are temporary and which are permanent. The consequences of misjudgment are severe. Doing too little will result in higher interest rates and economic pain, while being too conservative will harm the economy and households. Despite an unexpected strong U.S. jobs report, Federal Reserve Board Chairman Jerome Powell has maintained the need for further rate increases but also expects a significant decline in inflation. Powell stated that the process of lowering inflation would be bumpy and take time. The tight labor markets, particularly in the service sector, are being closely monitored for the threat of a wage price spiral. Similar circumstances are seen in Australia, where the Reserve Bank is forecasting further rate hikes in the months ahead. Central bankers face a difficult task in predicting inflation and interest rates amid unprecedented economic conditions caused by the pandemic, supply chain disruptions, government stimulus, monetary policy, and even a war in Europe. Sorting out which factors will be transitory and which are permanent is causing uncertainty and mixed messages. A misjudgment by central bankers could result in higher interest rates, hurting economies and people, or unnecessary damage from rates set too high. Fed Chairman Jerome Powell's comments on Tuesday indicated that a significant decline in inflation is expected this year, likely reaching the Fed's 2% target by next year, but the process will not be smooth. Powell stated that further rate increases are likely and borrowing costs will need to remain high for some time, but he did not express the aggressive stance markets expected after last week's strong U.S. jobs report. This was seen as a positive surprise for financial markets, powering the U.S. equity market, which has risen 8.5% this year, with the Nasdaq up 16% and tech stocks up 30%. Despite Powell's references to ongoing rate hikes, the market is pricing in peak rates by mid-year with a soft landing for the U.S. economy. In the U.S. and elsewhere, the tightness of the labor market is closely watched, as wage pressures in the U.S. appear to be moderating but the threat of a wage price spiral remains. Similarly, Australia faces high inflation, low unemployment, and predictions of further rate hikes, but the hope is that lag effects of recent rate hikes will emerge soon and a widespread wage breakout will be avoided. Jerome Powell, the Fed chief, warned of a bumpy process ahead in lowering inflation at a recent Q&A session at the Economic Club of Washington. Despite last week's strong U.S. job report, Powell maintained that the Fed would still probably need to do further rate increases. However, he also expressed confidence in a significant decline in inflation this year, predicting it to fall to the Fed's 2% target next year. Although rate hikes will continue, Powell stated that they should not come at the expense of the labor market. Financial markets responded positively to his balanced outlook, with shares rising and the U.S. equity market thriving. Nevertheless, the tight labor market, particularly in service industries, continues to be monitored closely to prevent a wage price spiral. The situation in Australia is similar, with inflation at its highest in 30 years and the RBA anticipating further rate hikes in the months ahead. Governor Philip Lowe is hoping for the lag effects of the recent rate hikes to show up soon and for the tight labor market to not lead to widespread wage increases.